Morning, Market Chameleons. Happy Wednesday, middle of the week. How you doing, Dima?
Good morning, Will. How are you?
Excellent. Income statement this morning. Is that correct?
Yep, I figured we'll continue since we talked about earnings yesterday. We jumped to fundamental fair value estimates. So I just decided, why don't we just go and continue on some of the financials. We haven't done those in a while. So we'll
Excellent.
talk about today. We'll go over an example of an income statement. I think I'll just use Netflix as an example. And we'll do, before that, I think we'll just really quickly take a look at what's going on in pre-market hours. If there are no questions, I'll jump to the income statement.
All right. Now, do you want, should I put out the link to the Zoom if people want to ask live questions?
Yeah, definitely. So if you guys have questions, there are two ways to do it. One is to put it on the live chat. If you have a question that you think it's better asked, through like a live question, and you want to, raise your hand, we'll turn you on. You could just ask a question that way, because sometimes it's harder to put, a question in a chat where you use like one line. So
yeah, and quite often one question leads to more questions. So it's good to go through the whole process.
Yeah. Yes. So yeah, we had that a couple of times. I think that was pretty good. If you have a question you'd like to ask, then Will, you're going to put in a link that
I'll put the link in the YouTube chat. Correct.
Okay.
All right.
Sounds
Before we get started, let's go to the disclaimer.
Okay. So everyone, thanks for joining us today. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer questions and provide you with guidance. There's the disclaimer.
All right.
And I'm going to share my screen real quick. So the first thing we'll do today is take a look at stocks trading in a pre-market hours. This is a list of the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm scrolling down here real quick, seeing that 54 made the percentage gainers list, 58 on the percentage decliners list. So from that perspective, it's pretty mixed. So there's no real, bias, bullish or bearish. Let's take a look at the higher market cap stocks. So I'm taking this filter market cap, looking for stocks 20 billion or higher. And now I got 9 on the percentage gainers list, 11 on the percentage decliners list. Again, pretty neutral at the open, not a lot of stocks on both lists. And, we got a pretty evened out. Nothing's jumping out at me as I'm looking at it. No huge volumes in here. So if there are no questions, I'm going to go to the income statement.
Perfect.
All right. So I just queued up here Netflix. So if you go, let me just show you how to get there. So if you type in Netflix up top in the search box, it'll take you to the Netflix page. If you come down here to fundamentals, click on income statement. On the left-hand side, that brings up the income statement. So what is the income statement used for? It's to take a look at how much money the company is making. How much are they making? What are their expenses? How much does it cost them to make? What are they spending? How much profit are they making? How profitable are they? And then we could look at a couple other metrics that we'll take a look at as, are they growing their profits? Are they growing their revenues? How does that look over time? So those are the type of things that we're going to be trying to answer today. And this is in Netflix, you have 2 types of reports, an annual and then quarterly. So every quarter they issue a new financials, how they did the previous quarter. And then at the end of the year, you get like one annual statement. You could tab here between annual and quarterly. I'm just going to stay on the annual for now in this example. And then another question comes up, well, where do you get these numbers? And companies have to report their financials. They file them with the SEC. So here we have a link here, view annual SEC filings. If you click on this, it'll take you to the SEC. These are going to be the annual filings. So you could see 10Ks, the historicals. If you click, they have documents, interactive data. If you click on the interactive data, that will take you to another page where you could just kind of click through, look through the financial statements here. So you see they have a bunch of them. They have notes to financial statements. So this is where it's coming from, the SEC filings. One difference to note is this, that when usually a company issues their earnings, the way we see it, the way you see it in the news, the way you see it in the headlines, that's usually done through a press release. And these are sometimes what they call non-GAAP numbers. So the filings with the SEC, they are GAAP numbers, generally accepted accounting principles. So everybody kind of sticks to the same methodology, but not every company is the same. So what they'll do is in their press release, they're going to give you their metrics, their non-GAAP numbers, how they're doing. So when you look at analysts' expectations, they're using what we call non-GAAP numbers. And, that's what usually the company issues in a press release. Then later on, whatever the time frame is, you've got like up to a week or so to file your official SEC with the SEC. Those are going to be GAAP numbers. So today we're looking at the GAAP numbers that are filed on the SEC with the SEC. Okay. Down here, here's kind of a graphical view of the data table below. So I'm going to kind of jump to the data table so we could talk about what each of these data elements mean. Then we could take a peek at the graph just to see how those metrics are changing over time. So you could see here, we got, from 2015 to 2020, how these metrics are changing over time. So at the top, when we look at an income statement, they could be larger than this. We took what we think is the most important top line numbers, and this is a good starting point. So we'll talk about the numbers that we're seeing here on this data table. So the first one is total revenue, right? So total revenue is, you can see here year by year, those are their sales. So if you sell a car for $25,000, that's your sales, that's your revenue. You received $25,000 in cash. That's revenue. Below that, we have cost of revenue. So what's cost of revenue? Well, if you sold a car for $25,000, how much did it cost you to make that car? Because you have to pay for the metal, you have to pay for the tires, you have to pay, for the labor, for the electricity. Let's say cost you $20,000 to produce this car. That's your cost of revenue, right? So $25,000 to make a car, $20,000 to produce it. Those are revenue versus cost of revenue. And this is all summed up. You sold 1 million cars, then it's $25,000 times 1 million. So in this case, we're looking at Netflix, $25 billion in revenue. They sell subscriptions to their, movie rental business, to their streaming business. So that's where they're generating their revenue from. So total revenue, 25 billion, cost of revenue, whatever they're paying for that, probably what they have to create content, pay licenses to lease other people's content, that's their cost. So if we take the difference between that, if we take the difference between what you sold it for, your revenue, and the cost, you get your gross profit. So an example I gave, $25,000, you sold the car, $20,000 it cost you to make the car. There's a $5,000 difference. So that's your gross profit. You sold it above what it made what it cost you to make. And you want to see those numbers positive, right? Now, you might see them sometimes negative, and that's not a good thing, but maybe you take a look more into the story and see why it's doing it. Look, sometimes you might have a lot of inventory. You might have to sell it below cost, right? You have to take the inventory off the books. You can't hold it. It's better just to sell it, start all over. Market moved against you. So it's possible you sell it below cost. Sometimes maybe companies have some kind of a model. Maybe they're looking for market share, whatever it is. You know, they're giving away products for free. So sometimes that is possible to have negative gross profits. I don't think it's not going to be sustainable forever. You can't have a business model, but it is possible to have negative gross profits. So you kind of want to, if you see that, you want to take a look, why is that happening? Okay. What about operating expenses? So besides the cost in this example of making a car, right? So you have to produce a car, obviously you need all the material, the labor, electricity, all this just to make the car. But there are other operating expenses besides just making that car that you're spending money on, right? You might have marketing expenses, right? So it's not directly making the car, but you have advertising expenses, selling, general expenses, like maybe secretaries that you need to hire, investor relations department. All these are other operating expenses to stay in business. You need those to continue to operate, but it's not directly an input into producing that product. Okay, so those are the other operating expenses. So now we got gross profit, then we got other operating expenses we need to deduct to continue going down to our profits. Another one was research and development. So you might be taking some of your money and spending it here on research and development. And these are kind of investments into the future, right? So if you're not spending anything on research and development, you kind of have a product and you're hoping that just demand for that product goes up, right? So you're basically selling the same product, and hoping that more and more people around the world keep buying it. Research and development is creating new products. It's creating or improving your existing products, creating new features, making it easier, solving other problems. So those are going into research and development, and you're hoping that, well, if company is spending money on research and development, these are investments that could potentially pay off in the future. Okay, so whatever Netflix is doing, maybe speeding up bandwidth, maybe creating more content that's, Netflix original, whatever it is, that could pay off in the future. So that's what we're looking at, research and development. You also have like depreciation, amortization, depletion. Depreciation is, let's just take an example. You buy a computer, right? Well, the government, even though you buy a computer and you need it to conduct your business, they may not let you take that expense as an expense that year. They will take the view, well, yeah, you bought a computer, you spent money on it, but it's worth something. It's not worth zero as soon as you buy it. And maybe they give it a lifespan. Maybe they say, well, this computer will be good for 5 years. In 5 years, it's going to be obsolete. We'll need to buy a new one. So you could depreciate the cost of it over 5 years. So let's just say, whatever, if you bought a computer for $1,000, and they say do a straight line depreciation, you could deduct $200 as expenses per year. So that's kind of like the way that depreciation, amortization, depletion, right? So it's an expense that you might have to take over a number of years. So once we take our operating expenses, we take our gross profit, we reduce our other operating expenses, we get our operating income. So this is income we receive directly from our operations. So here, Netflix, we see 4.6 billion. Now we go to, well, what about our pre-tax income? So we could see here, that's different than the operating income. Now, a company could have income and losses that is also not due directly to their core business. So let's say Netflix, their core business is selling stream subscriptions to a streaming service. That's what they're in business to do. That's where they're getting their day-to-day money from, right? That's what they do. But they could make other investments in there, for example, buying Bitcoin, like Tesla's doing. That's not related really to streaming service, but they could have other incomes in their expenses. They could own bonds, they could own stocks to other companies, do a bunch of different things. You'd have to go in there and take a look what they're doing, but they're generating income and expenses not due to their core business. So you want to deduct that to get to your net income, right? Other expenses that might not be due to their, to their that is necessary to their operations. If they make a donation to charity, it's an expense, but it's not due to producing the product. It's not an operating expense. Maybe you host a Christmas party. It's nice and it's an expense, but it's not necessary for their continuing operations. So these are things also deducted. Then you get into your pre-tax income, you pay taxes, then you got leftover net income to shareholders, 2.8 billion. So hopefully this makes sense how I'm going down the line. If not, will give me, let me know if you have anybody wanting to ask a question down below. Yep.
Robert did have a question. He was asking, and there's been a lot of chats. Let me just go back to it. Since Netflix is increasingly profitable, is there a relation? Yeah, I guess it's an opinion question, to the rise in Netflix price versus profit.
Well, you would hope that that's the case. Yeah, right. That the more profits you make, or the expectations to make more profits in the future, that's what's been driving the stock price, right? Because when you're buying a stock, you're buying a company, you're buying shares in a company, and a company exists to sell, goods and services and to generate a profit, or it's not going to be sustainable. If they're not producing any goods or services that anybody wants and they're not generating profits, it's not a sustainable business. So yes, but sometimes
it's got to have other components, right, to the stock price, to the profit, because it was for so long, it was driven by subscriber growth. So it's probably a balance of those two. If profit was going up, but subscriber growth was fallen dramatically, you'd maybe have not an increase in price. So it is a balance, keeping those things together.
It's a balance, and people will also price in future expectations, of growth or potentials for other revenue sources. So maybe right now, they have it's purely subscription based. Maybe they'll go to, a hybrid ad revenue and subscription based. Maybe they have add-on products that they could sell. Maybe they could license, Netflix only content to other services. So who knows? But there could be built-in other expectations we're not seeing right now reflected in the revenue. You'd want to go listen to what management is also saying. But yeah, it doesn't always necessarily have to be in line with just the financials that are being reported. There could be other things involved, and you really want to understand the business, understand the company, and kind of form that opinion going forward. So going forward is probably the most important part. What is your opinion going forward? But at least you have the numbers here to start working with, because you could see how effective the management is. So I'm just looking at total revenue here, and look, from 2012, started at $3.6 billion in sales. 8 years later, we're at 25 billion. They've been increasing it every year. That's showing you something, right? That's showing you that the company's out there and they're executing well, right? They're executing well on the revenue side, from what I'm seeing over here, and kind of reinforces some confidence in that management, right? So this is kind of, you're looking at a track record at this point. Does that make sense?
Yeah, it does, and it leads to a healthy discussion. I mean, I'm reading the chat, and Mike and Robert are going back and forth. They're talking about FedEx, I guess, is a stock that has been seeing increased profitability, but the stock has been, their underlying pieces of the company that people obviously follow, from earnings to earnings,
Right.
Delivery, whatever it is on the deliveries, each business has its own nuances, right? And if something shows up in those conference calls that people don't like and doesn't fit into the model, you could have an increase in profits, but yet the stock potentially falls.
Yeah, because these are, right, you're just looking at a historical track record. It's very important to paint yourself the picture going forward. If you have whatever it is, if FedEx has more competition, I don't know, like maybe from Amazon, can Amazon take over a lot of that business that they're giving it to them? Or Netflix might have the same issue. Right now there's more competition. You got YouTube getting into some streaming services, Hulu, Disney, Amazon Prime. You got to take all that into consideration going forward, right? So they're not the only player there. Are their margins going to get squeezed? Is there potential to slow down their growth? Maybe lose out to competition? These are all things you need to consider going forward. So you can't just take, sometimes you fall into a value trap, especially when the historical numbers look really good. The PE ratios look really good, but it could be a value trap, because going forward, things are changing, right? The things are changing, could be changing drastically for that business model. And I'll give a really quick example. Maybe at one point, selling typewriters was a great business and profitable, and maybe when word processors started showing up, those companies started looking like they have really good PEs when you're comparing it to historicals, but eventually they were replaced, right, with word processors. So you need to really pay attention to what's going on going forward in that business. And you need to make an opinion, you need to make a decision about that. Here, we're only looking at historical numbers, how they were able to execute. Okay. Also, they'll give you guidance. Let me just take a look real quick.
Actually, that, as you're mentioning, that Kishore was asking, do we have subscriber growth data for Netflix? I'm pretty sure that's something we don't have, but what we do have is the ability to look at it, kind of scan for it. You've shown that before.
Right. You could, right. I'm just quick under earnings. I went to earnings estimates versus actual, and we see that Netflix did guide higher. So when they issue a press release with earnings, they could issue as guidance, and they are showing us that their expectations is, their earnings per share, it's going to be $3.16, which is a big increase from the previous year, almost 100%. Their revenue is going to go to 7.3 billion. If we compare that to prior same period prior year, that's a 19% increase. Operating margin 25.5%. So they are issuing us guidance, and that's important because you want to see what is the management telling us, what are they seeing. They're the closest to their business, to the numbers. They see much more than any analyst sees, right? Because they're running the business day to day. So it's important just to take a look at, well, how are they guiding us, higher or lower? I think yesterday we took a look at Intel, and they had a great quarter, but they guided lower, right? So their expectations going forward didn't look so good. Netflix, they guided lower. I mean, I'm sorry, Netflix guided higher, right? So to me, it looks like they beat and they guided higher. So they are. And interestingly enough, I'm just looking at, this is where they closed. They were down 7.4%. And that could have been an opportunity there. Why is the market, down 7.4%? Because they beat and they guided higher and they were lower. So if you're looking at those numbers, maybe that presented an opportunity. Did the sell-off overreact? You would still want to, it could be valuations, but I'm just showing you really quickly what happened. If you go to the press release over here, you might be able to get those important numbers and metrics that somebody was talking about, their subscriber growth. This is the actual press release to their to the announcement. I think you have to go to the investor relations over here, and you want to go read through them, because you're correct. What might be important to them is the subscription growth, right? So, all right, they're making me click on a bunch of stuff, so I'm not going to keep going, but you can see here, you have to click your way to it. You could read about it, see what their subscription growth looks like. Okay, these are the individual links to the press releases correlating to these different earnings announcements. Let's go back to the income statement real quick under fundamentals. Were there any questions on that, Will?
No, you're good.
Okay. So when we look at the income statement, these are kind of the raw numbers. To make, but the raw numbers, it's hard to kind of make a quick analysis of how well they're doing. So we could compare them. We could change them to percentage statements. Okay, so there are two types of percentage statements. We'll go over each one. So the first one I'm going to do is go from just the basic values. I'm going to do the numbers as a percentage of total revenue. Okay, so this is as a percentage of total revenue. So we see here that this is revenue, cost of revenue. So up here, revenue as a percentage of revenue is 100%. So what is the cost of revenue? Here we see that it's 61%. Basically, it's out of every dollar you sell in let's say a car, or Netflix sells, it costs them 61 cents to make it. Okay, so that's your cost of revenue, 61%, which leaves you with a gross profit of 39%. In other words, if I sold this car for $1, it cost me 61 cents to make, then my gross profit, 39%. 39 cents I keep for every $1 I sell. Then we go down the line for operating expenses, percentage, research and development. So you can see here, 7% of their revenue they're putting into research and development. So what are their operating profits? Operating income, 18%. So for every $1 they sell in a car, if they subtract the cost of making that car, the cost, other expenses like marketing, research and development, administrative, depreciation, they keep 18 cents. Okay. Then, as we talked about, taking into consideration other expenses and income, we're going to go down to net income, 11%. So 11 cents they made in profit for every $1 they sold. That's a percentage statement as a percentage of revenue. We could also we could look at a different percentage statement that's year over year change. So this is telling us growth year over year. So here, total revenue, we could see how much revenue grew year over year. So from December 16th, from December 15th to December 16th, grew by 30%. From December 16th to December 17th, it grew by 32%, 35%. So you could see here, year over year, how much it's been growing every year, even though here it's slowing down a little bit. So the rate of growth is slowing down, but it's still growing at a healthy pace. We could do the same thing for cost of revenue, gross profits, net income. You could see here year over year growth. We're right up at 9:30, Will. So I'm going to stop there. If questions are popping up, we could continue on it tomorrow. If not, I'll just move on to the next statement.
Yeah, great job. Actually, Rob was, and I sent you just a reminder. I sent you a title for a show. He has some questions about earnings, and I know earnings are coming up in 2 weeks.
Yep.
So it could maybe be a title for another show. Great job as always, Dima. Chameleons, please, a thumbs up is always appreciated. I probably don't ask for it enough. I've also put the link in a couple times for Jake's show on Friday. He's going to be going over the call he sold. I think did he do a buy right, D?
I think you did a buy right in SPY.
Yeah. So I did put a poll out there this morning. We had a bunch of chameleons answer it. What do you think has happened to Jake's call? What do you think, D?
Or buy
in the
right.
money, out of the money, or at the money?
He did a buy right, not just a call.
Right.
So he sold a call and bought stock. He did a buy right strategy. So what do you think happened to the strategy, basically? Because there's two components to it. There's, the call component and the stock component. He kind of walked us through it, what he did, and now we're just tracking it to see how it progresses over time, right? And he'll talk about it tomorrow. Cool. I'm sorry, Friday.
Yep. All right, D, great job. Thanks as always, buddy.
Thanks, everyone. Stay safe. Have a good trading day, and hope to see you guys tomorrow.
Have a great day, chameleons.